Hello, Tony Daly from the Santorelli Exchange, and this video I want to show you a pre-earnings analysis of Alibaba, who announces earnings tomorrow. What I've done is I've taken the daily chart on Alibaba and I have marked it up and put some important lines there so we could kind of see what it looks like technically. So we've had, since it has gapped down here, it actually took all of this time to fill the gap. You see it came up and filled the gap and then immediately rejected it and sold off again. The past two earnings cycle we saw a sell-off and we saw another sell-off. No, we saw this is actually a gap up. So we've had one and one. So history may or may not repeat itself. We don't really know, but if we look at this one here, we see that we are clearly in a downtrend. And we've had it bounce off of this line and we have a descending wedge pattern here. Implied volatility is on the bottom, and again, as I showed in a previous video, you can see how implied volatility crushes post earnings, and we have had a run up in volatility into earnings. So right now we know that premiums are high, and we're going to look at some of the alternatives and ways we might want to think about trading this. So we're going to go over to the Analyze tab. Now what I have here is the weeklies for Alibaba, and this is the option chain. So we could see that it trades in 50-cent increments, so there's plenty of liquidity on this trade. So, so what I like to look at is I like to look at what the expected market maker move is, and that's right here. And that currently, the implied volatility is at 70%, which is high, consistent with a pre-earnings setup. And the market is pricing in a 5-point move on either direction of its current price. So if we look at its last trade of $80.47, we're basically looking at the market pricing in a 5-point move on either side. So that would take us to 75 on the downside and 85 on the upside. So anyway, that 10-point range represents a 1 standard deviation move based on the implied volatility. So that being said, 68% of the time this stock will stay within a 10-point range, 5 on either side. So knowing that, we have to think about a couple of things here. So based on how it's moved before, we could certainly calculate it out, and there's other ways that we could look and see how much it's moved previously. But we could see here it moved at least 5 points, and over here it's moved about 8 points. So we do tend to get some fairly large moves on Alibaba on earnings. So those of you that are bullish could basically look at it at 80.47. If you wanted to place an at-the-money trade, we have a weekly with 4 days to go, which is ranging between $2.56 and $2.63, or $263 a contract, if you wanted to play the calls. So that's certainly one way you can put it. And so your break-even is $80.50 plus $2.63, or about $83.15 or so. That would be your break even. So basically, once the earnings is announced and the stock opens up tomorrow, we basically need to see that stock trading at least that, because a lot of this time premium is going to go away. And I can give you an idea and show you a little trick on how you can figure out how much time premium is going to go away. You could see that the earnings week, which is this week, implied volatility is at 70%. Now look what happens next week. So now we announce earnings, implied volatility goes away, and look how next week the market has priced it in at $49.41% volatility. That's a 21-point drop in volatility. Now that has got to translate to something. That means that a certain amount of implied volatility and option premium will crush and come out of that. So you could be right on your direction, but if the stock doesn't move enough, you're going to lose so much of this time value, it's just going to go away. So how do we know how much is actually going to go away? Well, if we load our Greeks up and we look at Vega here, we see that Vega is 4 cents for the at the monies. Now what did we say it was going to drop? It was going to drop 21 points. That's 21 points. And 21 times 4 is 84 cents. So I could tell you right off the bat, I know tomorrow morning this premium here is going to drop 84 cents just in implied volatility. We're also going to have time decay coming out of it, and then depending on where the stock moves, it will have its own set of Greeks. So there's a lot of moving parts that are going to affect this stock once earnings is announced, and you have to take a lot of that into account. So if you were to buy this call and you take 85 cents right out of it, you need a fairly significant move to make money. That's why buying calls at earnings is a very, very difficult trade. Of course, we always look for those 6, 7, 8, 9, 10-point moves, which are considered home runs. But the implied volatility, which says that it's going to move 5 points, that will happen over time. That's going to happen 68% of the time. So 2 out of 3 times, it's going to stay within this measured move, and 1 time out of 3, it's going to move outside. So basically, you could think of this almost as a big roulette wheel, and it's very interesting. So people who want to trade earnings, and you are a long bias person and you are buying options, have to be aware of all of the risks involved. So here's another trick. So some people are going to say, well, you know what, I don't have all these numbers here in my platform. I don't have Thinkorswim. So how would I know how much is it's going to move? Really simple, guys, and here's the trick, and I want you to write this down. We take a look at the last price, $80.47. So we know this is the at the money strike. What I want you to do is add up the straddle. Now we know a straddle is the at the money put and the at the money call. So if we were to basic, and we could use the bid or the ask, this is just going to get us in the ballpark. If we add 255 and 263, that's $5.15, isn't it? Well, what did this say? $5.10. That's kind of close to me, right? So we're basically saying that the market is really smart. These option models are pricing in the at the money straddle to basically equal the 1 standard deviation move. So think about that. If I buy a straddle, I'm basically paying what the market thinks it's going to move 2 times out of 3. So if I don't know which way it's going to move and I want to hedge both ways and I just buy a straddle, I'm going to pay $515, and lo and behold, I need it to move more than that or go into the 1/3 of the time. Remember, 2/3 of the time it's going to stay within 5 points, 1/3 of the time it's going to go outside. Well, if I buy a straddle, I need it to hit that 1/3 of the time. So my odds of success are really not that great. I really do need the big move. And yeah, we got it from Google and we got it from Amazon, but I could give you several dozen that we didn't get out of. So you really gotta think about how you want to structure these trades. So what would I do? One of the things I would do is I would simply do something like a call spread. If I'm bullish, I could buy the 80.50s and I could sell the 80.53s, and I'll teach you this in another video, how to do the spreads, but you could basically see that this is only going to cost about $1.09. Now, yeah, I'm capped with how much I could make, but it's still basically a 2-to-1 risk to reward, and I'm not risking quite as much on this as I am if I just did the call. And my time decay is going to, and the option premium will be less because I have bought options and I have sold options, and sold options actually profit when the premium comes out of it. But that's for another video. So basically the message is that when earnings comes, you are paying very high for the option premium. You need to know how much the market thinks it's going to move. You have to look at prior moves to see if it has actually achieved that. And then you go ahead and put your trade on. These are high risk, potentially high reward trades, but unfortunately the majority of them are going to lose money. So if you have any questions, you could drop us some questions, but hope this helps, and there'll be additional videos on this series. I'll actually do a video post earnings on Alibaba so we could actually see how we did. Okay? See you soon. Bye-bye.